bit of a shock this morning, I've got to be said, when I woke up and discovered that, in actual fact, the Labour Party has policy. I was thinking, good God, they don't have policy. I've worked on the assumption that they won't be releasing any policy prior to the election, that they'll just simply say we're not the National Party, and that will be good enough. So I got a hell of a shock when here I heard that they'd released a capital gains policy, capital gains tax. And that it will be campaigning, they said, on introducing a targeted. Then I looked out and went, no, it's a targeted capital gains tax on profits made following the sale of commercial or residential property, excluding the family home. And I thought, oh, yeah, all right. But there was a lot of other things that are connected with it. So we've gone to something of an expert in the field. Well, he's in actual fact so much of an expert that he's been recognised by successive governments and appointed to 2 tax working groups by them. A former partner of PwC, what's that, PricewaterhouseCoopers. I wonder why there's a small W in that. Anyhow, I'll talk about, and a whole series of other large advisory firms, Geof Nightingale, and he joins us now. Geoff, welcome to the show. Thanks very much for joining us.
Morning, Michael.
Why has PwC got a small W? Is it
I'm not sure.
It was PricewaterhouseCoopers, wasn't it?
Yeah, it was, and there was the big mergers of all the firms in the 2000s or the late 90s. So, and that's the branding they come up with it. But that predated me.
Oh, okay. So I wouldn't have liked to be the Waterhouse in that, you know. And listen, the other thing you can tell me, I'm sorry, before I even get you on, and we've just spoken for the first time, you're Geoff with one F. What happened? Was that short for Jeffrey and that was REY and you had one F in it?
Yep, yeah, it was short for Jeffrey, but I had 2 Fs in it. But when I was very young, I simply cut it in half because everyone called me Geoff, and so, yeah.
Ah, okay. I've never seen it done that way before. Okay, all right. There you go. So Geof. Anyhow, Geoff, lovely to have you on. All right, now you are a bit of an expert in this area, so you would have observed this morning's announcement with some degree of interest. Can I ask, first of all, um, what's wrong with the capital gains tax? Why are parties so scared of it when I've looked at an opinion polls at the moment and they seem to go roughly in favour of some form of capital gains tax finally being introduced into this country? Can you explain to me what the fishhooks are?
Yeah, this is the eternal problem of the principle versus what actually happens in reality. And so, in principle, if you make $1 from going to work and making labour income, and that dollar's taxed, and if I make $1 selling my batch, $1 of gain selling my batch, that's the same dollar, right? It's just economic income, and it probably should be taxed. So that's the principle. Most people get that principle. What happens in reality, though, is that a comprehensive capital gains tax, which this is not, but a comprehensive one, becomes very complicated very quickly, and 2 big problems. One is the complexity, and so all the definitions. How do you define what's a family home? How do you deal with lifestyle blocks? How do you deal with death? How do you deal with marriage dissolution? All of those complexities, starting with a very simple principle, it rapidly becomes complex. And then the second concern, which is very important, is the effect it might have on innovation and economic growth. Because if every time a business is transacting an asset, the government takes a slice out for tax, that's reducing the amount of capital available for investment, basically. So those are generally the 2 big problems. There's a whole lot of other things in the detail, but those are the 2 big problems in getting a capital gains tax in reality, as opposed to what is a pretty simple principle.
Okay, so you've sat on 2 tax working parties and had a significant input, as I said, into 2 successive governments. I imagine you've addressed this issue. I'm sure you have. Explain to me the bit about innovation and growth. So I'm a business and I want to buy another building or invest, but I want to sell that piece of land over there so that I can fund that. Is that what you're saying? That would then
Yeah,
attract, because it's got a
yeah.
capital
So
gain on it, the tax?
so let's just say I'm a transport business and I've got a marshalling yard, um, which I store all my trucks and various other things, and my business is growing fast. And so I sell my marshalling yard, and let's say I paid $1 million for it, and I sell it for $2 million. I've made a $1 million gain. Now, if that gain was taxable, I'd have to pay, under Labor's proposal, 28%, so $280,000 of tax. So after selling for $2 million, I'm left with 1.72 million cash left after paying the tax. And then I've got to go out and buy my bigger yard. And so it's got a bit harder for me to buy my bigger yard to support my growing business. And that's, if you like, the dampening effect on investment and innovation. Now that can be solved. And this is where the complexity comes in, because what people do overseas, Australia, US, and all, is they provide rollover relief, and they say, well, we recognise that problem. We won't tax you on the sale of the yard, as the marshalling yard, as long as you reinvest the proceeds in a similar business asset. We'll roll over that capital gain, and we'll only collect it when you fully retire and exit the business. And so that rollover relief, and so that solves that problem. But you can imagine the complexity of rules that have to track that embedded capital gain for 10, 20, 30 years and then collect it at the end. So that's the example of both the effect on innovation and the consequent complexity.
Having said that, I mean, property development is the one that's so often looked at as an example of that should be taxed, because they're in it for as much for the capital gain as they are for the development of the property. Were you able to differentiate that?
Yeah, so property development is already taxed. So we have a bunch of rules around property development that have been in the Income Tax Act since 1970, and they just say that if you are developing a property as a developer, or you're trading in properties, or you're buying properties with the intention of flipping them to make a profit, that is just treated as ordinary income and taxed under our ordinary system, and that's been the same since 1970. And
Okay.
then an overlay on that is our 2-year Brightline test, which was targeted at residential property.
Yeah.
And residential property investment. So what Labor's proposal does is extend the boundary of taxing residential and commercial property some more. It's incrementally extending that property rather than being a completely new thing.
Yes, but the list of exemptions is incredible. It won't apply to farms, so if they get a capital gain from the farm, it won't apply to that. KiwiSaver, shares, business assets, inheritances, and personal items like cars, boats, art, and furniture. Well, the question then becomes, what does it apply to, Geof?
Yeah. Yeah. So, and it's, we haven't seen the detail yet. All we've seen is a very sparse press announcement. So the devil will be in the detail. But it really only applies to a residential investment property and commercial land. So it can't really be described, in my view anyway, as a capital gains tax. It is really just an extension of income tax to some very gains on very specific types of property. And in that sense, it's quite sort of coherent with New Zealand's current tax framework. We don't have a comprehensive capital gains tax, and this isn't one. But what we do is, where we see systematic gains being made that look a bit like income, so property developers and things, we fire rifle shot rules at that issue and try and take them into normal income. And this is, in my view, looks like just an extension of that sort of approach.
So the next question, obviously, is they're announcing it as a targeted property tax to fund free doctors' visits. But I guess the question is, well, how much does that cost? I think 3 a year they're budgeting on for everybody, I assume, but we'll find that out a little bit later on. How much money would you estimate that they would be able to get from this targeted property tax? And because the question I would have is, will it change behaviour? It's almost, I mean, the kind of people that are in this sort of business tend to be quite innovative. Will it change behaviour, do you think?